Good afternoon, ladies and gentlemen. Thank you very much for inviting me to the Netherlands. This afternoon, I want to talk about exits in kind of the global context. As Hank said, I've been a technology entrepreneur my whole life. Later became an investor after my first exit. And I've come to believe that it's actually easy to invest, but the real art is getting your money back. And for the last decade and a half of my career, what I've focused on is the exit process and what makes entrepreneurial companies work and not work. And I want to share with you this afternoon my perspective on that as a Canadian. So I live very near to the country that Hank just described, but we are much closer than you might think to being a country like the Netherlands in terms of size and even some cultural similarities. And so what I'm hoping I can do is create some discussion to stimulate some thought that would ultimately be helpful in your companies and in your investments. I want to start off by talking about how I perceive that exits have changed in the last 5 to 10 years. And the most important message that I'd like you to think about, and my personal goal this afternoon, is to stimulate your thought about the belief that I have, the observation that I have made, that only 25% of the companies that could actually be sold end up successfully exiting. So what I'm saying is that if you build a successful company and it becomes valuable, 75% of the time, you will fail at the most important part of the process, which is the exit. And what I would like to do this afternoon is to describe some things that I would hope would be helpful to you in getting your company and your investments into the 25% instead of the 75%. You know, we're living through a very interesting time. The economy is changing. The whole world is changing. Today, we have entire countries that are bankrupt, and there will be other countries almost certain to follow. It seems to me that the world has become a much smaller place now, driven by low-cost air travel and especially the internet. And many big parts of the financial ecosystem that we took for granted that worked well for 100 years just don't work at all anymore. The economy has changed, the whole world is changing, and I think it's happening faster than ever before. To illustrate, I'd like to use a Canadian example of a company called Nortel that was in the telecommunications industry. They were founded in 1882. And in 2000, Nortel was fully a third of the value of the entire senior exchange in Canada. It was certainly most Canada's valuable company in 2000. Their market cap was 398 billion Canadian dollars, same as American dollars. They employed 94,500 people in 2000. They were bankrupt in 2009. And the parts, the assets, were sold off to countries all around the world in a very distressed sale. So I asked myself, was that just a Canadian example or a random event or a made-in-Canada failure? So I started to think about the other great global technology companies. Here, without a doubt, is the most successful semiconductor company of all time, Intel. And what I'd like you to think about when you think about this graph is that if you take out the stock market bubble in 2000, which is that peak, that graph has been flat for a decade and a half. Similarly, the world's greatest software company, regardless of whether you love or hate their products, Microsoft has been the most successful. Again, factoring out the bubble, the result is eerily similar. The greatest networking company of all time, it's exactly the same picture. None of these companies have created wealth for their investors, or I think more importantly, for their employees, for a decade and a half. And the reason I think this is important is that these great companies were all built on the increasing value of their stock options, mostly for the employees, not for the investors. It was the stock options that used to bring the best and the brightest new minds to work in these great companies. Today, the world is very different. Today, what I'm seeing is the best and the brightest, the new graduates, the young people are going out to work in startups and much younger companies. And it's these small companies that are creating the opportunities. It's where the innovations are happening. And if you look at what has been happening in North America, only because we have good data there, it's very different than it was 10 years ago. 10 years ago, it seemed that if you had a big company, that was a competitive advantage. Today, in North America, it seems that being big is actually the opposite. And now what we're seeing is that the economic growth is all being driven by the young companies, the startups. This is some data which I won't spend too long on, but it was done by a research organization called the Kauffman Foundation. And they show that over the last 35 years in the United States, all of the new job creation, and therefore I think the economic growth, came from startups. All of it. So the interesting thing about this from an exit perspective is that when we read the media or look at the online sources of information that we follow, we always read about these really large exits. It's very exciting to read about YouTube selling for $1.6 billion, or Club Penguin from near where I live selling for $350 million, or AdMob selling for $750. Those are exciting stories, but they're actually very rare occurrences. I think that the new big story is about the much larger number of smaller exits that you don't read about in the press. When I wanted to find out exactly how big the average exit was, I went out and bought all of the databases that I could find and spent an embarrassing number of weekends trying to find an answer to the simple question is, what is the average or median size of a private company M&A transaction? The databases would show that it's about $25 million, but there's this very annoying little footnote that says when the price is disclosed. And that's what burned up all of my weekends, trying to determine the probabilities of the price not being disclosed as the size changed. And what was pretty easy to show was that it's the smaller transactions that are not announced. The smaller transactions are not announced primarily because they're not material transactions to the acquiring company's financials. They're probably not acquired by public companies, so we never hear about them. And I have no doubt that the median price is well below $20 million. And I'm quite sure, but I can't quite prove, that the median price of a private company M&A transaction is under $15 million. Now, this is North American data, I apologize, but there just isn't data available anywhere else that I've been able to find. And I think it's probably pretty similar globally. But the surprising thing is that the median size of an exit is much smaller than I would have ever imagined before I did this research. And I think that the key point to keep in mind when you're thinking about your own companies or your own investments is that half the time, companies are going to sell for less than 15 million US dollars. Today, in the 21st century economy, what I think seems to be working is that the small companies are the ones that are now creating the innovation. They're the engine that's driving the economic growth today. They're usually financed by angels, friends and family, and possibly new model venture capital funds. But then, at a much earlier time than we thought before, big companies will acquire them, and then the acquiring companies will go on to fund the majority of that business's growth and to scale those businesses up. And what we're seeing, especially in North America, is that the entrepreneurs and the investors then recycle those capital gains, start the process again with new, vibrant, younger companies. That's what seems to be working. You know, I believe, after being an entrepreneur for the better part of 3 decades now, that exits are the best part of being an entrepreneur or an investor. It's when we get paid back for all of our hard work and our risk capital. But it's also the least well understood part of being an entrepreneur or a private investor. And the reason is simply because it doesn't happen very often. We just don't accumulate a lot of experience in an entire career about the exit process. So summarizing the first section, I think today, selling a business is usually the biggest financial transaction of our careers, even if we do it a few times. It's exciting. It will certainly change the lives of the senior people and the majority stakeholders in the organization. And much of what we thought we knew about exits has changed quite dramatically just in the last 5 to 10 years. But the good news is that if you're thinking about selling a company anytime soon, this is an excellent time in the economic cycle to be thinking about an exit strategy. That's the end of the first section. Any questions on what I said so far? Anybody want to disagree with me or ask for, please? Sir.
What happens with the other 75%?
I'm going to talk about that in a minute, but the sad answer is they usually fail.
They go bankrupt? Or?
Yes. A very new observation that I'm quite eager to talk about and be interested to see if I've answered your question in a few minutes. Other questions?
I have a question. I mean, you talked about medium tax strategy around 15 million. What about the average?
Good question, Peter. The average might be a little bit higher. It might be 20 million because there's a disproportionate number of much larger transactions. But we don't really have good data. You know, the best data that I can get is a median or maybe an average. There's a real scarcity of information about the exits because about 80% just aren't disclosed. Moving on to the second section of what I'd like to talk about this afternoon is I believe that every company should have an exit strategy. And this is one of the things that you can do that will very significantly put you into the 25% and not the 75%, in my opinion. You know, it's surprising to me that much of what we hear about the exit process is wrong. And I think it's dangerously wrong. There are a great number of myths and misperceptions. And many people who are experts, and when I put the quotation marks around that, that tells you what I think of their claim at being experts. And there's quite a few dirty secrets about how this part of the financial system actually works. I would like to suggest that the exit is just another business process. And we all know from running companies that whether you're doing a financing, a product development, or launching a new marketing or sales goal, that the chances of success are much greater when we have a goal and a plan. And I would like to suggest that the exit is no different, and that you should think about it the same way you think about any other process in your company. I think that the exit strategy is just the plan for the business, the entire business. And like all good plans, it should start at the end with the goal. One of the myths and one of the misperceptions that I hear very often is that companies are bought, not sold. And what I think people mean when they say that is that when it's time, someone will magically come and knock on the door and ask to buy the company. And I admit that that does happen. But when it does, it's almost never good news for the stakeholders. And it's not just because the price will be much lower than the fair price. It's also because the probability of success will decrease dramatically if there's only one bidder. I have no doubt that an optimum exit requires strategy and planning. It is something that is done by the selling company, not done to the selling company. Another misperception you hear often, and we talked about at lunch, was that the entrepreneurs and the company management should focus on the business and not worry about the exit. In my opinion, that's just plain wrong. And I think a focus on the exit is healthy. It does not distract the team from their primary function, which I believe is to maximize the shareholder value. In fact, I think it does just the opposite. I believe that entrepreneurs, and especially angel investors, would have better returns and a lot more fun if we designed and built more companies with a focus on the exit. It's working particularly well today at the early part of the 21st century. So I think the next question is, well, what are the steps? Where would you start if you were to believe that we should be focusing more on the exit? Well, I think the first part, the indispensable part, is to have a clear exit strategy. And this doesn't have to be complicated. I think a perfectly workable exit strategy can be as simple as, and this is an actual case that I used from a company that I was on the board of, we said that the exit strategy was to sell the name of the company in about blank years for a certain number of dollars. I think there's only two essential ingredients: when and how much. In some cases, the exit strategy could be elaborated. You could include some of the tactical elements like, we plan to engage a mid-market M&A advisor by a certain date, or we plan to achieve these corporate milestones before realizing the exit valuation we're looking for. But really, it's just when and how much. It's absolutely essential. And the optimum exit strategy depends on the type of company. It's not something you can necessarily drive internally. And it's something where I think that entrepreneurs and management very often need some help from people outside to design the optimum exit strategy for their company. And the reason is that it requires a perspective on what's happening in that part of the economy, the M&A part of the economy. And it requires a perspective that's almost impossible to do a good job of if you're the CEO or if you're a board member and so much of your thinking and time has to be devoted to running the business. This is a function, and I think very often needs some outside help to be done well. One of the things that I learned early on in my career was that how often there is a serious lack of agreement or lack of alignment amongst the principal stakeholders in a company on the exit strategy. And this is especially true of companies that have been around for 5, 10, or more years. And I think that the only way to determine whether or not you as a CEO or as a board have alignment on the exit strategy is to literally write down that simple exit strategy and then have it signed by all of the principal stakeholders. And this can be surprisingly difficult. Many times with companies that are 5 or 10 years old, I've actually had to go and take them away for an entire weekend and just address this one question of what is the exit strategy before a consensus could be formed. And I think even after you have that initial consensus, I think that you should get the exit strategy re-signed annually. I have some friends in America who run an early stage investment group out of a place called Ohio, and I don't know where that is either, but they are actually taking this one step farther, and they're making me now come to believe that maybe annual is not frequent enough. And this group, very successful group now in their companies, reaffirms the exit strategy at every board meeting. They do it at the beginning, it takes 15 or 20 seconds. And the experience that they've had is that more frequent alignment, again, increases the probability of success, increases the probability of a smooth process through the transaction when the time is right. Very new thinking, not something I would have even thought just a few years ago. The next thing I'd like to suggest that companies could do better and to get more likely of being in the 25% is to think about the exit strategy before you finance the company. And I want to admit right up front, this does not happen very often. It didn't happen in any of my companies. This is one of the things I learned not to do by doing it the hard way. But I think that the right way to build a company is to determine the type of business that you are planning to build, then to build alignment on the exit strategy, and then develop a plan to finance the business, and only then start to contact the investors. And the reason that I think this is so essential is that different exit strategies are compatible with different types of investors. And if you make a mistake, and if you entice an investor into your company that has a different perception of the exit strategy, it can be fatal. And I came this close to losing my first company just by making this mistake. And I have put up a video on my blog about all of the things that I did wrong in my own first company exit, principle of which was not understanding the importance of developing that alignment and checking it regularly. The model that I like to use to describe why this is so important is a biological one. And I think when you start a company, you're starting it with usually a group of entrepreneurs, and it's typically very compatible DNA. And the entrepreneurial organization usually thrives because of the similarity of that DNA. But when you go out and you entice an investor to invest in that company, in my mind, what you're doing is you're combining the DNA of that investor with that entrepreneurial DNA. And the resultant organization is a hybrid of the two types of DNA. And the reason I like this biological model so much is that we all know that when you combine incompatible DNA, that often for a while things seem to go okay. But then as the organism gets to be sort of middle age, you start to realize that something is seriously wrong. But by the time that you see that there's an incompatibility, it's too late. And you can't fix the DNA once you've combined it. And the result is almost always fatal. So I think what I wish all entrepreneurs, all founders, all CEOs did was to check the compatibility of the DNA that comes with that money before you combine it with your company. Because once you've done it, it's almost impossible to undo. Another common misunderstanding about the M&A exit process is that you have to grow the company to be profitable. Or you often hear that the company has to be bigger than $10 million in revenue or $50 million. I think today, much different than it was a decade ago, the real requirement is only to prove the business model. And what it means to prove a business model is different in different types of businesses. But to use as an example, a company that is based on a subscription model, where every month you get a certain amount of money from people, for example. When you can get to a point where you can show the gross margin per customer and the average customer lifetime, or the churn in that customer base, and what it costs you to acquire one more customer. When you can get to the point where you know those things about your business, not projected, but know, then I think you can answer the simple question of what's a customer worth and what do they cost to acquire? Some businesses have slightly different things you need to know before you've really proven the model. But when you can get to the point where you can say, if some new owners came along and they added X million of new capital, that then they would end up with Y new customers, and they would have created a certain amount of additional value. When you can get to that point, then you can sell the company. And it's when you can have a conversation with a potential acquirer about the value of that company. It can be as simple as that. And you do not have to be profitable today. And you can even sell a company in this very unusual market before it has revenue. Selling the company as soon as you can prove the model, in many cases, is also the optimum time to sell the business. Again, not something we would have even thought 5 years ago. But, it's always better to sell on an upward trend. Sometimes it's better to sell on the promise rather than the reality. It's often when you can get the best price for a company. And we all know from running companies that very often stuff happens. And I don't know what they call stuff here, but there's all kinds of other words that are not usually as polite for what we call it when we're actually operating businesses and things happen. But what I've seen happen most of the time is that the people who create, operate, often love their businesses, will wait too long to start thinking about the exit. And what they do is what I call riding it over the top. And they end up selling the company after the peak in the value. Another major contributor to this phenomenon of why only 25% of sellable companies actually exit. I think that if you have a clear exit strategy, there's also many operational benefits. A good exit strategy will maximize the overall generation of shareholder alignment through focus and alignment. And it also will affect very many management decisions. In my experience, weekly decisions that are made will be modified if there's a clear exit strategy. And it's also particularly important today in recruiting and retaining the best and the brightest people. In summary, I think the exit strategy is simply the highest level strategy in the organization. It's the foundation for the entire company plan. It aligns the team on the most important goal, which is the maximization of the shareholder value and the optimum timing of its monetization. With the footnote that this is assuming this is a company with investors. If someone owns 100% of the company, then it's their right to do whatever they would like to do with it. Maybe they just want to grow it and leave it to their children. That's a perfectly valid exit strategy if you own 100% of the company. But I think for the rest of the companies, the vast majority, then the exit strategy is not only essential, but a healthy ingredient in the overall company plan. Any questions on the exit strategy? Why it's important? Anyone want to disagree? Either I've got 100% success or nobody's really interested. All right, let me go on to the next section, and you can come back to this and see if it stimulates some more questions. I have a number of resources on my blog that are easy to find. You can just search on my name. You can find these anytime. If you can't, just send me an email. I'll be happy to point you to them. The third thing I want to talk about is this tendency, this very high probability that people who operate companies, people who own companies, will wait too long and ride it over the top in value. One of the things that the internet has done for us is it's accelerated almost every part of business life. Today, we can market and sell to hundreds of millions of people worldwide in just days. But it's not just the sales and marketing. The internet has also accelerated many other parts of the business process. Recruiting, research, development, all can be done differently today than it was possible to do 10 or 20 years ago. One of the interesting things that I'm seeing is that groups of entrepreneurs, and I'm not sure how popular this is here, but in North America, they often have these functions they call weekenders. Is that a term that you've heard here? Is that a sport in the Netherlands? Well, in North America, what they do is they get together, they'll rent a hotel room, they'll have a liberal addition of alcohol, and they will set about for the weekend in conceiving, creating, and getting operational an entire company. They will conceive of a business that they had no idea they were going to start, and they'll build the entire business in a weekend. And this happens all the time in Vancouver. This is maybe several times a year they'll have these. They're like a game, a contest for entrepreneurs, an excellent training experience in my opinion, and they'll build an entire company in a weekend. And in 2009, when I wrote Early Exits, which you will all receive a copy of at the end of this presentation, one of the things that I wrote was that I speculated that one day they'll probably define an early exit as selling the company before the end of the weekend. Well, to my surprise, in that same year in November, that actually almost happened. Because it had become passé to build a company in 2 days, a team of crazy people in London built a company in 1 day, because that hadn't been done very often before. And they have a video, which is actually quite entertaining. It only takes 2 or 3 minutes to watch, but it shows what they did to build a company in 1 day. And they sold it 10 days later. I think they wanted to try and sell it by the end of the weekend, but it took a few days longer than they wanted to sell the company. Now, this was certainly a stunt. This was a demonstration. This was a fun thing more than it was a serious thing. But it does, to me, illustrate the tremendous acceleration in the timeline that we're seeing, especially in the younger entrepreneurial age group. The 20s and 30-ish people aren't really surprised by this anymore. And if you really were interested in this, there's actually a fascinating site called Flippa, which is a bourse for selling early stage companies. And there's companies that sell on Flippa every day for $10,000, $100,000. Again, it's a phenomenon we did not see 10 years ago. There were no transactions where you bought and sold companies for tens or hundreds of thousands of dollars. But another illustration of what is different today than just a decade ago. Let me give you some examples of, which I admit are North American technology companies, just because I tend to bump into those more often. And these are examples of companies that were sold in just 2 or 3 years. And I will admit, these are outliers. These are not the typical companies. These are, extreme events. But it illustrates a point I want to make. A company from Vancouver called Flickr, which was a photo sharing company, sold for $30 million when it was a year and a half old. Delicious, which many of you I'm sure used, sold for $30 million when it was 2 years from startup. Club Penguin, another company near to where I live that made a children's game, sold for $350 million when it was 2 years old. YouTube sold for $1.6 billion when it was 2 years old. Playfish, $275 million at 2, Mint, $170 million at 3, AdMob, $750 million when it was 3.5 years old. So, acknowledging that these are outlier events and transactions, the point that I want to make is that it's possible to create a great deal of value in this new accelerated timeline just 2 or 3 years from startup. Something we would never have thought 5 or 10 years ago. In British Columbia, I want to give you an example of a company that I was very close to that I think illustrates how fast this can happen. Local startup, 2 engineers, phoned me up one day, half out of breath, saying that they had conceived of a product, they'd done some paper designs, and they did what good entrepreneurs should do. They went out to test whether there was a market for what they wanted to build. So they called on a couple of sort of mid-size American companies, and by around the 3rd conversation, one of those companies was asking if they could buy the company. So the CEO phoned me all out of breath saying he needed some help. And at first, I wasn't even sure whether I should take this seriously. But to make an interesting story too short, 3 months after that phone call, the cash was in the bank. And this was a 7-digit serious amount of money that was in the bank. And this company was acquired less than 12 months from startup. They still hadn't built the product. They did one thing right. They did file a couple of patent applications, which these days you can do for a few $1,000s each. But it illustrates, again, just how fast some of these acquiring companies will move. And I don't know exactly what was in the mind of the acquiring company, but I think what happened was that the company said, this is a good idea. We would like to buy this product. The smartest thing we can do is to buy the company now. Because if they can build this, we're going to spend much more money buying the product over years. So why don't we just buy the company? Again, very different thinking than we would have seen just a decade ago, but an illustration of what is kind of commonplace now, not just in North America, but we're seeing the same kind of attitude. Companies in Asia are starting to be this fast to move. I think this will continue as a trend through the remainder of this business cycle for some other reasons that we'll talk about in a few minutes, predominantly the extreme amount of capital that's available and unused in the system. For me, as a student of the exit, I'd like to describe one that impressed me. Anyone heard of a company called Pumpkinhead? I hadn't heard of it either, and nobody's ever heard of the company, but you may have heard of the product. It was an online product called About.me. A couple years ago, your inbox probably filled up with a bunch of people inviting you to join this. It was kind of an online identity product. What was interesting about that is this company was acquired by AOL 4 days after the product launched. So they launched the product, there was a big flurry of activity. 4 days later, they announced the sale. And that may be a new record. I don't think it's the right way to measure it. Again, I think there's an element of showmanship in this. 4 days after launch, we sold the company. I think the right way to measure it is how long after they founded the company did they sell it. But even then, from what I've been able to gather, this was sold about a year after it was started. And what's interesting about this is that the people who started this company weren't your typical young online entrepreneurs. You know, when you look at the pictures of these guys, they have the same amount of gray hair as Hank and I have. These were veterans. They had done this many times before. And I would suggest that this group of very experienced gray-haired entrepreneurs knew exactly how to sell a company. And I'm pretty sure that what they did is they resourced the exit team at about the same time they resourced the software development team. And I think that those teams must have run in parallel. And when the product was ready, these veterans, these gray-haired, gray-beard entrepreneurs knew that was probably the best time to sell it. So they timed the whole thing perfectly, and they sold the company 4 days after they launched it. There's a sequel to this story that I don't know the full details of yet, but I noticed a little while ago in one of my news feeds that the same group actually bought it back from AOL. Again, very different things than we would have thought 10 years ago, but illustrate what's happening today in the economy. It's a very different environment today for M&A transactions than just 5 or 10 years ago. You know, one of the questions that I often get when companies ask me about the exit isn't how much can we sell it for, but how long does it take? And I think in terms of planning successfully, the timing is more important than the absolute magnitude of the number. The short answer, which I don't like very much, is that it takes 6 to 18 months. And I don't like it because it's not a very precise time. It offends me as an engineer that I can't be more accurate than that. And I measure that from the time that the M&A professionals are engaged. That's kind of when, in my mind, the company's made a serious decision. They have an action plan. Now they have a team. They've actually committed resources. That's when I count the time as starting. And until the money's in the bank. So it includes that last quarter of the process where it's all about the legal work getting done. But the timeline, and the reason that I have to be vague about that, is it often depends on the state of readiness of the company. And companies, depending on how well they've been thinking about the exit, can be at very different stages of readiness for the process. And what I would like you to think about, and hopefully will help you be part of the successful 25%, is that what would be perfect, if we could only do it, would be to incorporate this 6 to 18 month delay from the time that you decide to sell until you would close the transaction into the company's plan. And look forward in time to when you could determine that there's going to be the maximum value, and then start the process. And so what I'm trying to suggest, totally theoretically, absolutely impossibly, but in an ideal world, would be that you start the company would go through its rapid growth phase. There would be this optimum time to exit that would be about 12 to 18 months from the peak in the value, and you'd sell the company right at the top. Again, idealized. The point, though, that I want to make is that while this never happens, what does happen a lot of the time is that the operating team will miss that peak in the value. It will start to sink in that perhaps this company's future isn't quite as rosy as we thought. You know, the environment's changed. Then a little bit of time passes, and then they say, you know, maybe we should start thinking about selling the company. And then you add the 12 to 18 months, and by the time that you get to the serious negotiations, it's clear to everyone that the company's value has peaked some time ago, and you end up selling for a much smaller amount than you could have if the timing was better. You know, one of the things about this unfortunately, very common graph is the inordinate amount of financial loss associated with that imperfect timing. Most of the money that could have been made in this hypothetical example was never captured. But that's not the worst news. The worst news, I think, is there's this big part of your life that you're never going to get back. Where you come into work, you work very hard, and the value goes down. Often entirely beyond your control. Often driven by external macroscopic economic events. But the heartbreaking thing when I see this happen is that these people, this team, these entrepreneurs, have spent all this part of their life, often years, decreasing their economic value. Simply because they didn't have the foresight, the planning to plan their exit nearer the peak in the value. But that's still not the worst news. The worst news is that what actually happens is most of the time, when you miss the optimum time, the end result is a smoking crater. Missing the optimum time to exit is correlated very highly with ultimately failure. And I had seen this happen over and over again. I'd seen companies that I knew could have been sold, and I would follow them, usually in my own backyard, because I have been there for my whole career. And I'd noticed time and time again that these companies, which I knew could have been sold, ended up failing. And after seeing it a number of times, I started to recognize a few patterns that explained to me why, if you miss the perfect time, the most likely outcome is failure. And I began to appreciate that there were some elements that repeated, not in every story, but there was a group of elements that commonly repeated through these sequences that resulted in these failures. And the reasons, I would love to spend a whole day on this, and I'm going to go quickly through this because I can't do justice to this, but I want to leave you with the idea, and you can come back and look at this later. There's a number of reasons why this happens. One of them is overinvestment by VCs, increased competition, something I call negative momentum, and what I do want to talk about in a little bit more detail is a wave of consolidation. Very quickly, overinvestment is something we see very commonly today because there is too much capital. In the global economy, central banks here in America are all flooding the system with capital at prices that are lower than we've ever seen in our lifetimes. What that means is that even though it seems as entrepreneurs it's hard to access capital, we're actually in an environment where there is so much money that when funds see an area that's promising, they will usually put too much money into the sector and create distortions in the fundamentals of that business market. Another thing that happens is very often startups, by their very success in this new hyper-connected world that we live in, will stimulate competition much sooner than it would have happened before because we're all so connected and everything is accelerated. Another thing that happens is, especially I see this where I live, I see it in America a lot as well. Today, the shortage that we have in the new economy is people, not capital. And when a company peaks in value, the people inside can feel it. They know that the company isn't as vibrant, isn't as exciting as it once was. And what happens is when this fun and excitement starts to dissipate, the best and the brightest will go somewhere else. They will just quietly start to leave the company. And this will actually create more negative momentum. And the feedback loop works the way that you didn't wish it worked. And when a company starts to slide down the value curve, that factor alone accelerates the process. But I think the most devastating reason that if companies miss the peak, they often end up never exiting, is something that I call a wave of consolidation. And this is the most devastating reason, in my opinion, that we see companies that don't exit at the right time failing. And this is another one of these new phenomena. This did happen 10 or 20 years ago, but it happened much less often. And it's driven, I think, by this internet acceleration. And the thing that's so devastating about this effect is that if you miss this, it's virtually impossible to fix after the fact, and the result is almost certainly fatal, even though it may take years for the ultimate result to be known. The way this works is because today, all of us take for granted that we're connected in real time to anybody else in the world that we want to connect to, through social media and all kinds of online news sources. Even as we walk around, we have computers in our pockets that are more powerful than the ones that ran the universities that we all attended. And what that lets us do is see what's happening in the world, and especially in our business sector, faster than ever before. And today in business, if you think about competitors, today, unlike a decade ago, all of our competitors have almost all of exactly the same information at almost exactly the same point in time. And what this is doing is it's causing different organizations to come to the same conclusion at almost the same time. And if you look at how large companies are growing, especially in the North American context, most of them are growing primarily through acquisition. And most of them have more cash than they really can find a use for. And so they're under pressure to acquire. And what's happening is that these buyers are also all networked together through this new interconnected media that we all live in. And they'll all make the decision to acquire at about the same time. So let's, for purposes of a hypothetical example, imagine a situation where there's 3 large competitors in an industry. And they're all run by smart executives, of course, and they all have lots of cash. When they see a technology or a market create an opportunity for one of them, they'll usually all 3 see it at about the same time. Like within weeks, sometimes they'll all come to the same conclusions, but independently. It's just because they're all working in the same facts and working in the same market with almost perfect information. Also, what can happen is sometimes it's an external event. Sometimes a competitor or a new technology will be very noticeable in the media, or something else will happen, and they'll all decide at the same instant to acquire a company in this sector. And sometimes it's just an M&A advisor. Sometimes it's somebody who has an assignment to sell one company. What they'll do very often is contact everyone in the world who might be interested in buying that company. So a good M&A advisory team might go out and contact 100 potential acquirers. And that's kind of a catalyst, and what it does is it starts this cascade of similar thinking. And what happens with the buyers is that they have learned that they can also get more opportunities presented to them by going out and talking to professionals that work on the buy side, professionals that go out and buy companies. So they'll go out and they'll get a number of firms going who will also contact every prospect in the world. And a competitive bidding situation will often develop, which is exactly what the sellers want. If you're selling a company, this is the ideal outcome. But these buyers are smart. And from a buyer's perspective, regardless of how they got the idea, once they've made a decision to buy a company of a certain type, they will look at most of the companies in the world that are available. And they will also let professionals know that they want to buy a company of this type. And pretty soon, they'll all start to make unsolicited offers to these companies. And this is one of the reasons that if you, as a company, receive an unexpected, unsolicited offer, it's really bad news. The buyers do this for very obvious self-interest reasons. One of them is that once they've made a decision to acquire, they want to ensure that they have options, partly to increase their negotiating leverage, but also to be sure that once this is done, they don't have to go back to their boss and say, gee, Mr. CEO, I know you upped your bid twice for us to acquire this company. We were second. Nobody wants to go to their boss with that news. So what they'll do is they'll also have a list. And this all starts a cascade of events. And soon, every company has received 1 or 2 offers to be acquired. And this is what causes this wave of consolidation. The buyer interest brings in more buyers, more professionals, which flushes out more companies, and often starting them on a secondary cascade where they all start their own exit process. And it builds to a flurry of acquisitions in this niche or sector. Often, all of them will be announced in 1 quarter. And from the outside, it looks like this all happened instantly. It looks like a spontaneous event. But it's not really. What it is, it's something that's been going on for several quarters, but all under very strict non-disclosure agreements, especially when there's public companies involved. Not keeping this confidential can actually land you in jail because of the securities laws in many countries around the world. So what happens is that if you see this wave coming, if you receive one of these unsolicited offers, most of the time, it's too late to react. Most of the time, companies that wish they could respond cannot do a good job. And if you weren't prepared, this wave of consolidation will happen. And if your company wasn't acquired, so you're a CEO, one day your phone won't stop ringing, people offering to buy the company. It's exciting. You're often kind of sanguine about this, expect that this will continue. Overnight, the phone stops ringing. And if your company didn't get acquired, it's almost impossible to be acquired the next quarter. But that's not the bad news. The bad news is that after this crescendo of acquisition, each of the companies that wanted to be in this sector will have paid, let's say for argument's sake, $10 or $20 million, just to pick a small number. What most acquiring companies will do is they will set aside an equal amount of capital, or maybe twice as much capital, that they will invest over the next 1 or 2 quarters to grow the business that they just acquired. Because these big companies, remember, have more cash than they know what to do with. So this is how they allocate some of that cash. And what they will do is they will start a very fierce competition for market share. And they will expend, that'll be an income statement loss of 10 or 20 million in a company they might have only paid 10 or 20 million to acquire over the next several number of years. The companies that were not acquired are now in a very different situation. Their market has instantly become much more competitive. And instead of fighting it out in the market with other small, underfunded companies, all of a sudden they're up against the giants. They're up against companies with enormous capital and highly effective brands. And these small companies just cannot afford to compete on that kind of playing field. And these small businesses were often very profitable. Almost overnight, they become unprofitable. And at the worst possible time, they also realize they cannot access new capital. And the reason they can't access new capital is the investors noticed that there was just a wave of consolidation. The investors have been around and seen this before, and there is no way that they will fund a fight against the big guys because the chances of success are just too small, and there's no opportunity to exit later. So missing this wave of consolidation is a particularly heartbreaking error because many of the companies were very valuable and often quite profitable, and that wave will destroy both. And for the CEOs that have built valuable businesses, I believe that not missing that wave of consolidation might be the CEO's most important job. And it's not to blame the CEOs. Most CEOs are just so busy operating their company, so focused on their market, that they can't possibly do a good job at this. And this is also not an easy thing to see because this is all happening behind closed doors under very strict NDAs. So I think that the best way for boards and shareholders and CEOs to keep some view on this is to speak with people who are M&A professionals. They're the people that are most likely to get an early view on this and most likely aren't under an NDA. So I think an important job for companies like this is to have a network of people who do this all day long, keep actively connected, just to make sure that you're not surprised by this happening in your industry. I've said a couple times that my most difficult part of my job, and one of my least favorite parts of my job, is to explain to a CEO or a director who phones me up excited about an unsolicited offer that it's probably not good news. And it's not just because of this wave of consolidation, because if it is, at that point, they're dangerously late. But the timing is such that if you can drive the process, you can have a much better outcome than by letting the process happen to you. And I would suggest that in many parts of life and business, timing is almost everything. It's especially true with exits. And I think if we could time our exits better, we could significantly improve our investment returns and the outcome for all of the stakeholders in the company. So I hope that what people would do is, in every company, have someone watching the exit, have someone whose job it was, probably the CEO, taking advantage of some relationships with outside professionals, keep a view on whether or not your company was getting ready to be experiencing one of these waves, and that instead of letting it happen to your company designed an exit strategy, developed an exit plan, staffed that plan, just like any other process in the business. I think that would dramatically increase the probabilities of you having a successful exit in your company. Questions or discussion on exit timing? Anybody have any questions? Want to disagree?
I have a question, but it also links to the previous section about the exit strategy itself, which was, according to you, the highest level, most important strategy. I wonder, if you look at exit strategies in a narrow sense, like you gave the example of exiting at X million in Y years, how actionable such a strategy is. It's nice to make statements like that, but how do you translate it into day-to-day decisions?
I think it's absolutely actionable. And I will admit, before I go further, that it's not always the case. We're living through a very unusual time. And the last module in my talk is going to be about why this is such an unusual time. If you look through economic history, there have been times when you probably couldn't have done much to affect your exit strategy. And that was because we lived in a different economic environment. But today, having an exit strategy is actionable both internally and externally. Because, first of all, internally, we can control what happens in our own organizations. And if the exit strategy is clear, then lots of decisions would be made with the goal of maximizing that shareholder value and fitting into that exit timing. Things that you might even not factor in consciously, but because it's clear to people in the team what the company is trying to achieve, decisions will change. But it's also externally actionable because today we live in a market where the selling companies have the luxury of driving the process. As you'll see in the next section, this is a seller's market. There are many more buyers than sellers. It's a uniquely wonderful time. So in this period of time, and for as long as this lasts, companies can absolutely drive the process. Other questions?
Sir. So what is an investor buying? Suppose a company has, let's say, 4, 5, 6 people. The ideas are coming from the entrepreneurs, saying the owners, the proprietors, right? What is he buying when those people are leaving the company? And shell.
These big companies that aren't growing are desperate to find some way to grow again. And they know, especially in North America, they've accepted. And I think maybe it's a little bit different here in Europe, but the big companies in North America, as you'll see in a minute, they know they're not good at innovation. They've conceded the point. So they also know that they cannot buy those people. All they can really do is rent them for a short period of time. So they're willing to spend tens of millions, maybe not hundreds of millions, but tens of millions to acquire a 4 to 6 person team with some good ideas and hope that they will stay for a year or 2 years. That's exactly what they're doing. Again, as surprising as that is to me as well.
It is surprising to me as well, because we have an hour in our television. We have been talking to Cisco's, including the Harrison's before, right in the beginning of introducing the product. Now they are extremely successful in the product.
To be acquired? I think you should speak to Hank. He can help you with. Sir.
The U.S. We've been around also talking to a lot of investors, but they're very traditional, low risk in Europe compared to North America. As you say, you're very high risk. I think there's a huge difference. They all wait and they wait till your profits are up, and then they calculate like 10 times EBIT, and then maybe you can come back.
It works very much like that in Canada as well. Even though I live within, say, 50 kilometers of the US border, in my hometown, investors sound very much like yours. And so in my particular case, what the entrepreneurs usually do is drive across the border, because these days we're seeing capital be more mobile. It is a problem here in Europe. What I understand is that angel investors, small funds are not as aggressive yet. And I don't know what the answer to that is. But I do know that in the M&A market, it's a pretty homogeneous global market. People who acquire are just as happy to acquire companies wherever they are in the world, because there just aren't that many, and because there are so many more buyers than there are sellers. Let me get through this last, sorry. ma'am, and then I'll get on to this next section.
You talked about, I think, two different kinds of acquisitions. You talked about the waves in which the companies still want to invest in the company they're buying. But how often, especially in the very early stages, does it happen that the companies get bought just to stop the production or to quit the work of a possible competitor?
You know, it's a good question. And it's a common, I think, misperception that a company might be acquired to stop what it's doing. I in my own career have never seen that. I have seen many companies acquired to stop them competing and driving the price down. So they might acquire them, keep the company alive, but the prices might magically increase shortly after. But I've yet to see an example where something was bought to be shut down. Let me talk about the last section, and then we can continue the conversation after the panel as well. The final thing I want to talk about is one of the biggest reasons that we live in a different environment today is the buyers. In every market, you've got to have buyers and sellers. Well, today, for those of us that are shareholders and entrepreneurs, the good news is today there are more buyers than there's ever been, and they have more cash than they've ever had before. You know, as we recover from the mortgage crisis, and we all lose sleep over the European debt problem, investors all around the world are trying to adapt to poor equity returns for over a decade now, the lowest interest rates of our lifetimes, and concern about the future value of our money. And the result is an enormous amount of capital looking for better returns and at least the perception of some better safety. Today in the M&A market, people buying private companies, we're seeing, of course, the big companies. I talked mostly about big companies, but a much larger number of medium-sized companies, private equity funds that are back, something that I'm calling boomer buyers, family offices, VCs operating like private equity funds, and a significantly larger number of international buyers. And very quickly going through these, you know, the big companies are very visible. And there's no question that most of them now are spending much more on acquisition than they are on internal development. Because, quite simply, they've learned that this is the best way for them to grow. Many of these big companies have large teams of people, 30, 50 people, whose only function it is to acquire companies. And most operating executives now, people who are line managers, will have elements in their compensation plan encouraging them to acquire, because these companies are under such pressure to buy new businesses. They're motivating everybody to find acquisition opportunities. These big companies often have so much cash, it's a problem. And they're under pressure more than ever to deliver returns to their stakeholders. Remember those flat graphs? Those stakeholders are not happy. And what they're also noticing is increased competition for acquisitions in what they would consider their sweet spot. The perception, increasingly, is that this is probably a good time to buy because prices and competition are increasing. Big companies today, I think, can be understood by summarizing a lunch I had recently with a very good friend who runs a big division in a Fortune 500 company. And he admitted to me over a bottle of wine that the big companies know that they aren't good at new ideas or startups. In North America especially, they've just accepted this now. They know that they're basically bad at building businesses from zero to, say, $20 million in value. But what they have come to appreciate is they're particularly good at scaling businesses. They're good at taking things and growing the values from, let's say, 20 million to 200 million. They understand that that is now their unique competitive advantage. He went on to say that when a company gets to $100 million, it's getting difficult for him to acquire. And this was a surprise to me, because this is one of the biggest companies in the world. One of the reasons, he said, was when you get to 100 million, it requires board approval. And then he said to me, kind of under his breath, he said, you know, and that means that my CEO wants to help. And he had that look like you hear when the government wants to help. But what he said was, he said, if I want to buy something for 20 million, all I have to do is get the CFO to sign the check. And the way he did it, it was like the CFO signs those checks all the time. And he said that if he could find one a month, he would buy them. But he just can't find enough $20 million companies to satisfy his own demand. And all these companies are spending more money on acquisition than they are on R&D because they know it's the best way for them to grow. They just accepted that, again, maybe more in North America than they have here. Google is a particularly open company in Hank's backyard, and one of the things that I'm grateful to Google for doing is demystifying some of the process around their acquisition strategy. And one of their senior people, Charles Rim, one of the top sort of 5 people at Google that buys companies, did a webinar recently where he said that 90+% of our transactions are small transactions, less than 20 people and less than 20 million, and that is truly the sweet spot. And I was surprised, sorry about that. I was surprised to hear him say that because I didn't appreciate that even Google, that has more money than any of us can imagine, is still thinking about acquisitions in that kind of price range. He surprised me further, pardon me for 1 second. He surprised me further by going on and saying, the most exciting thing he said was that they prefer companies that are pre-revenue. That was a real shock even to me. And what I think he was meaning there was that they don't really care what the revenues are. They could be maybe below $1 million. It's the same thing as zero to them. Because they have so much revenue that whatever it is isn't going to be accretive in their company. And there's a copy of that webinar that I've got up, linked off my blogs. I think it's so instructive to hear how somebody inside Google thinks about that process. And I think it's the same kind of thinking in almost every big company. Today, the big companies have learned that the larger acquisitions are actually quite risky. And boards now appreciate, and CEOs especially are nervous because if you do a really large acquisition, best example would be when YouTube was acquired by Google. If it doesn't go perfectly, everybody knows. And the board knows very quickly, but the shareholders also know soon after. And if it fails, the CEO, through his entire career or her career, is not going to live that down. And so what the big companies are doing now is they're taking more of a portfolio approach to their acquisitions. And they're buying larger number of smaller companies that are below the visibility range so that they can fail and not have it be quite as visible. Apologize for this small technical glitch. I thought that battery had more reserve than that. One more second. But for every big company that's known well to all of us, much more important, I think, are the medium-sized companies, which are in much larger supply. For every big company, I think there are probably 10 times as many medium-sized companies that can also afford to buy a company when we're talking about something that's worth $10 or $20 million. And the most likely buyers for your company are probably not one of the really big companies, simply because of the statistics. Statistically, there's a much higher chance that it's going to be a company in the medium-sized range rather than the absolute biggest companies that we all are very familiar with. So most of the time when a CEO actually sees who bought their company, they're surprised because the name was often completely unfamiliar. Even though they compete in that sector, the company that ends up buying them is maybe a $250 million or $500 million revenue company that they have never heard of. Another very interesting phenomena is the private equity funds. And private equity funds are much like venture capital funds, but the difference is that they'll buy 100% of companies, hoping to grow the value and then resell them later. And 2 years ago, only 13% of the transactions that we saw in North America had a private equity fund involved. Before that, it was about 40%. I think right now when the statistics come out, it's probably back to around 40%. So they're very active today in the medium to larger size M&A market. A fascinating new phenomena is what I call the boomer buyers. And the boomer buyers are another one of these new phenomena that we did not see just a short number of years ago, but they're showing up more and more often now. These boomers are often quite successful, wealthy people who haven't been getting good returns on their capital now for a while. And like a lot of us, they've been, a lot of them had thought they had retired, but they've been eating well, they've been working out now for decades. And what they're realizing is that after they retired for a few years, they could only play so much golf and they could only drive so many expensive sports cars, and they get bored. And they realize that the most fun that they've had in their lives is when they were running some kind of business. And while they might not want to be a CEO again, because they remember how much work that was, they want to be involved. And some of them are being angel investors, and they're making minority investments. But a significant percentage of them are teaming up with friends who also have money and thinking about buying entire companies again. And the thing that's fascinating to me about these boomer buyers is that they are often the most aggressive and fastest moving of all of the types of buyers we're seeing in the market today. And most of these people made their money by running companies. And unlike the other participants in the market, they're often the smartest guys in the room because they've been pre-selected by their success to have all this capital. You could have access to capital just because you moved up in a corporation. You could have access in a private equity fund because you went to business school and you got hired. These guys are often the ones wearing the open collar golf shirts, but they're also the ones who will decide fastest and bid highest for companies in this sort of $20 million range, which is, again, above the median size of transactions. Family offices is a term that we hear often in Europe, but hadn't heard much of in America. And since the mortgage crisis, this has become another very big phenomenon in North America because a lot of the really best and brightest from Wall Street have quietly moved into family offices. And a lot of the wealthy families have quietly moved their money out of the big Wall Street firms that brought us all collateralized debt obligations, and now having their money managed as you have here in Europe for 100 years by captive investment managers working in family offices. They have the same problem. They haven't been able to deliver a good return. They're looking at asset diversification, and a lot of them are allocating a portion of their portfolio to buying companies. The family offices, when I speak to them, all have the same complaint. We cannot find enough companies to buy. No shortage of cash, shortage of targets. Another fascinating thing to me is how the venture capital thinking in North America has changed. This is something that's not been talked about very much, and I think it's because the venture capital funds are operating a little beyond their mandate with their investors. But what we're seeing quite frequently now is venture capital funds acting just like private equity funds. The venture capital funds are coming in and very quietly either buying almost 100% of a company. They're also very often cashing out the founders and the earlier investors. And the reason is that it's such a seller's market that this is what they have to do to be able to deploy some of their capital. Fascinating new phenomena. And today, whenever I read about a large investment in a company in my backyard that I know was saleable, I'll go later and see if I can find out what really happened. And my trick, by the way, is usually I find out from the lawyers because they didn't sign the non-disclosure agreement. And very often what's happening is the founders are no longer required to come to work, which is one of the first indications that this was a buyout, not an investment. And you can also often see the visible signs of some of these founders actually having been completely cashed out by the VCs. And I think what's happening in the venture capital companies is that they are just finding themselves in a very competitive market. And this is the only way that they can find to deploy medium amounts of capital in North America. International is also an increasing phenomenon. And this is happening globally. People from here who have euros, not so much as maybe 6 months ago, but very nervous about the future value of euros, looking at diversifying into dollar-denominated active business assets. It's much worse than Asia. They have lots of dollars. They like them much less than you like euros. The people in Asia are realizing that they're this deep in American debt, and don't have any solution, but what they're quietly doing is trying to trade that debt back for active businesses, and are becoming another important phenomena in this market. International buyers are still not a big part. They're not as frequently seen, but it's an increasing part of the M&A environment, and I think will be more important going forward. Very quickly, to give you an idea of how much cash some of these companies have and how much cash there is in the system, this data is now a couple quarters out of date. I haven't looked lately. It's not that interesting, but some of these big American technology companies have tens of billions of dollars of cash sitting on their balance sheets. And when the CEO goes to the shareholder meetings now, the big fear, the question they don't want to have because they can't answer it is, what are you going to do with the cash? And we've seen in the last few months, some of the big companies have actually forced the management to give the cash back to the shareholders because they can't deploy it fast enough. If you look at all of the cash in the system, and again, this is not perfectly accurate. I threw this together one weekend because I was curious myself about how much money is there out there. American corporations have about $2 trillion of cash on their balance sheets. What's interesting is about half of that is not in America. Half of that is outside of the American tax system, and therefore is very eager to find a use, some reason for having that cash in the balance sheet, very much driven to international acquisition. Globally, companies have about $8 trillion of excess cash. It's about twice as much as it was a decade ago, because through the mortgage crisis, company management did what they should, which was to operate prudently to conserve cash. They've done such a good job now that they realize that they now have much more cash than is useful. Private equity funds only have 0.4 trillion, not a large amount, but that amount is supercharged by professional management who is highly motivated and compensated to put that money to work. The boomers, interestingly, have $8 trillion of investable capital. That's not real estate capital, that is investable capital. Not all of that is targeted to acquisitions. But it's interesting when you see what's happened as the boomers have aged. Boomer individuals have as much cash as US boomers have as much cash as global corporations. So just a little bit of thinking amongst the US boomers, and of course there's lots of boomers here in Europe that are equally wealthy, just a little bit of that shift in thinking towards acquisition creates an enormous additional supply. And family offices just in the US, this wasn't even a word 10 years ago, have $1 trillion that they're trying desperately to deploy with professional management. So I asked myself, how much is $1 trillion? Like this previous slide had $8 to $20 trillion. So it's a number that I'm not very used to, never having had anything. I don't know how much that is in sort of gut level. So I tried to figure it out from an M&A perspective. Most of the acquirers, regardless of whether they're big companies or whether they're boomers, think of 20 million as kind of the sweet spot. Medians, maybe 15, 20's a good number. So each of those 1 trillions buys 50,000 companies. And that, for me, kind of tries to sort of put in perspective how many dollars there are out there hoping to find a company to buy. And there are just so many more buyers today than there are sellers. It's almost impossible to really describe how big this oversupply of cash and undersupply of companies is today. So today, if you're selling something for under 50 million, the number of buyers is virtually unlimited. And what we see, which makes it fun, is very often we'll have 3 or 4 different types of buyers all competing to buy one company. And it makes for and each one of them acts and thinks a little bit differently, but they all have lots of cash. And for any given company, there's only one successful bidder. So we're in a market today where it's definitely a seller's market. It's very fast moving and very diverse. It operates under a completely different set of rules than it did 10 years ago. And what I'm hearing, this is the talk at functions that I go to with other professionals, is that prices are up about 20% in a year, simply because there's this oversupply of cash compared to the supply of companies that are available to be acquired. So putting all this together, I say very often that I think that history will come to call the time that we're in now a golden era for technology entrepreneurs. Never before in history has it been so easy to create such valuable companies on so little capital and sell them so early for so much money. That's my summary of where I think we are today in 2013. Questions? That's the end of the presentation. So questions, and then we're going to have the panel. And there can be more questions during and after.
Are you sure you're making the presentation today and 15 years ago in the mid-90s?
It's an interesting analogy. You know, the mid-90s were driven by a stock market bubble. And if I was giving this presentation, then I'd be saying, go public. It's like a really great way to make a lot of money. It hasn't been a great thing to do for the last 10 or 15 years. And the similarities with the private M&A market to the tech public bubble are notable. You know, I don't know how long this will last. You know, I secretly hope that it'll last the rest of my working career, like 25 more years. But I think realistically, we're at a point in history where there really hasn't ever been the combination of these macroscopic economic trends. And it all focuses on, if you're building a company, think about selling it before the end of the cycle. If you have a company, I think this is a time that every management team, every stakeholder group should be thinking about, you know, is this an opportunity that we don't want to let pass by?
Since there are many 50,000 companies for sale, or at least can be bought with 1 trillion, is there not a recursive problem? Because if you are an entrepreneur now and sell your company, you become a boomer. So you have a problem. How do you do that?
You know, that's a very astute question. And I actually expect now, when I see a boomer founder getting ready to cash out, and you know, at first there's a inability to imagine this event because it's so unfamiliar. But when the reality starts to sink in, around the time that the buyers are starting to seriously negotiate, all of a sudden the light will go on and they'll say, what am I going to do with all this cash? And I don't have a good answer for that. It's a good problem to have, though.
When do you think this, let's say, new golden era will end, or explode, or implode, or?
You know, I don't think anybody can know for sure. And it's really a question for how skilled you think our central bankers are now. Whether they can take us from where we are, a little bit of a precarious situation, a great deal of cash available, and at some point they will have to slow this down. Otherwise, this type of distortion that we're seeing in the M&A market will start to move into the mainstream economy, and then it'll be maybe not over, but it won't be quite as exciting as it is now. Sir?
At the risk of this being a very silly question, but given it's a seller's market, and from your perspective, what does the medium company look like? What does a $50 million company look like? The one that has the enterprise value of $15 million. What would it look like?
A very good question. And to me, the sort of median company probably has 10 to 30 people. It's probably gotten to the point where they've proven the business model by actually competing in the marketplace. Probably has somewhere in the range of $5 to $10 million in revenue, depending on the nature of the revenue, really depending on the gross margin and the degree to which the revenue is recurring. A $20 million SaaS company, a software as a service company, might only have $3 to $4 million in revenue. People today are paying, they might only have $2 or $3 million in revenue, actually. They're paying incredible values for SaaS companies. I think there's a micro bubble in the macro bubble for software as a service companies. Another fascinating phenomenon I'd be happy to talk about after. But that's kind of what the median looks like. Sir?
For a SaaS company, like you just described, what would you advise to attract people? Because without hiring directly very expensive M&A expert, is there any advice you have to tap into the truth?
Yes, I do. And you know, this is something that I strongly believe should not be done by the existing company management. And I have other sections that I often speak about at workshops like this, which is more planning oriented. And I describe why I think that in 99% of cases, the CEO should not be trying to drive the exit. The simplest and most important reason is that to maximize the value, the C-level team has to focus on the business. They've got to focus on bringing in the best financial performance of the company's entire lifetime. And an M&A transaction is a very distracting event. And it's also a significant amount of time required. Typically, it's 1 to 2 man-years of experience to execute one M&A transaction. And no C-level team that I've ever met has a spare 1 to 2 man-years of effort just laying around underutilized. And most of the time, the C-level teams that are good at operating businesses just don't have the experience to sell the company effectively. You really need experts to do this. And so I think that for all of the reasons, the best advice is to find a group of M&A advisors who are knowledgeable about your kind of company, who are hopefully reasonably near to where your company is, and who can, in your opinion, do the best job in selling your company. And add that resource of experienced, capable senior people in to execute the exit. I'm seeing lots of very young entrepreneurs who understand this very well. But I'm also seeing angel investors and venture capital investors who are, because it's their business to look at this, they're also seeing these trends and reacting as well. Your question about Europe, I'm not an expert, but my perception is that it's a little bit further ahead in North America. And I'm not sure why that tends to be the case, but the Americans tend to be more innovative in the financial industries. It's not always a good thing, as we saw with the mortgage crisis. But I think this trend is not driven by any one culture or one economy. These are now macroscopic trends, because as we're seeing, the economies of most of the developed world are very much synchronized now. And the central banks are acting the same way. The economic growth is coming from the same kinds of places. So I think what you're seeing perhaps in North America is just a slight view into the future of how more people are going to be thinking here in Europe. It'll be interesting to see.
And to summarize your answer, it will be that the entrepreneurs and angel investors are farther than us. Is that really given assets on that point?
Yeah, probably, yes. Yes.
Just a few months ago, we sold a SaaS company exactly in the sweet spot area, you said. And we were lucky, I think, but it was sold to a big customer. How do you see that? It's also a big company. How do you see the trend that customers or channel partners buy their company? This can be also very dangerous.
First of all, congratulations. It's actually quite common that customers will end up paying the most for a company. And it's because if you're a customer, you know exactly how valuable the product is and exactly what you could do with it in your channel, because you understand your channel. So yes, customers are frequent acquirers, but your point is an excellent one, which is it's also very dangerous, because customers may be uncomfortable with the fact that they don't know who the new owners of your company are going to be. And if you've done the job that you should for your stakeholders, you've created a competitive bidding situation where even you won't know who the successful buyer is until very late in the process. So the fear that the customers will have is that somebody that they don't get along with for competitive reasons ends up becoming the new majority shareholder, and that can be disconcerting.
Sorry, in Israel, I don't know if it's a trend also in Canada, but it's a SaaS company, so it was a multiple revenue price, but it was part of the revenue, a big part of the revenue was from themselves. So it can be, and if the deal went okay, but if the deal doesn't go okay, you are a big risk of losing your customer. I don't know if you see that also.
Definitely. Oh, absolutely, that's a risk, because the competitive buyers might also worry that they're going to lose that business because of the new dynamic and might try and devalue the business in that situation, which is often one of the things that leads to the customer ending up being the most comfortable with the highest price.
We see a trend in venture capital, the private funds developed towards trying to invest more money into one single company. Now, if I understand this correctly, what you're saying is that often the value of the company peaks at about 15 million. And if you don't want to be, let's say, the little bit either side as an entrepreneur, that means that you have to take venture capital early on and never more than say 2 million.
Yes, absolutely. This is part of this new economic reality which is making it difficult for the old model venture capital funds. And when I say old model, I'm thinking of, sort of the Sand Hill Road, Silicon Valley, people Hank was talking about that have so much money. They're having a difficult time now because I'm not sure, Peter, that the peak in the value is 15, but the most likely exit is 15. So the median price of the exit is 15. And you're right, you can't put much more than $1 or $2 million of capital into a company if all you're going to get back for everyone to share is 15. And these funds that we built in the 90s, these venture capital funds, which we're seeing quickly disappear in North America, were built on sort of billion-dollar scale. They were, typically $500 million to $1 billion in size. And when you have that much capital, your tendency is to try and put $10 to $20 million into each investment. And that math just does not work anymore. Now, that math only worked during the time when there was large IPO exits. And that really only happened for 5 years in the late 90s. And unless that comes back, which no one's predicting, that you're going to have venture capital funds will be smaller and more nimble and able to invest only a few $1 million in most of the transactions.
Thank you.